Well, joining me now on the phone with much more on the muni bond markets is Matt Fabian. He's the senior analyst with Municipal Market Advisors in Westport, Connecticut. Matt, so is it the case of buyer beware then in the muni bond market right now?
If you're buying muni bonds, you have to know what you're getting into. This is a great opportunity to be buying bonds for income, but the values of individual bonds are going to be unpredictable. So if you're buying bonds for total return or for asset preservation, you do have to be careful. Again, it's all about what you're getting into the muni market for.
Okay, so how do you differentiate then? When you're looking at states like Illinois that just put in a 67% increase in income tax, how do you differentiate between the states that are going to make it or the munis that are going to make it and those that don't?
Well, make it implies potentially default, right?
Yes.
The number of munis that are in default right now, there are only 15 rated muni bonds in payment default, and none of those are, what you would think of as traditional, munis like states or cities or counties. So the number of bonds in default is extremely low. We really don't think that there's going to be a wave of defaults. There are enormous structural protections for bondholders, even in Illinois, which is has been in the center of the storm. Even with the very difficult budget condition, sort of the reckless politics and the poor disclosure, the risk of bondholders not getting paid is extremely low.
So they're right. So they're still going to get paid. However, these states that are taking this type of action, New Jersey included, if you're an investor in that state or in that bond, are you actually going to then, on the opposite side, take a better view because they're taking tougher action?
No, that's exactly right. Because this crisis, states and cities have a lot of different stakeholders. It's not just bondholders. It's also employees and taxpayers, service recipients and vendors, and bondholders are extremely well protected versus all those other stakeholders. So right now, what you're seeing in Illinois, in California, and in New Jersey, they are forcing pain onto taxpayers, onto service recipients, because those guys, frankly, are first in line as far as helping to balance the budget gap. States like this and big cities, they default when they choose to default, right? They have to make a political decision to not pay debt service. We're seeing absolutely no indication of that. Willingness to pay, at least, on the surface and based on political statements, very, very strong.
Right, but just that final question, though, Matt, is that, because it kind of sounds like, okay, we know that the muni bond markets could be in trouble because of what's going on with states and municipalities, but on the other hand, they're not going to default. So you're kind of in this netherworld sometimes when you're talking about the muni bond markets.
Well, there's worry about, what's going to happen. And default risk is different from rating risk. So bond ratings may fall, but, the individual bonds may lose value. Default risk is still really low. The bigger effect here is one on sort of, the country at large, right? Rising taxes, reduced spending by governments is going to slow down economic growth. It's going to be, possibly a large net drag on economic growth over the next 3 to 5 years.
Yes, we've been hearing that, and certainly want to talk more about that. But Matt, we'll have to leave it there. Matt Fabian of the Muni Market Advisors calling us from Westport, Connecticut.